Here we go. Back to another stock market open. Well, it's already open. Back to another stock market live stream. Hey, so I just saw word that apparently here Refinitiv is reporting that there was a terror plot for New Year's Eve. And the terror plot for New Year's Eve was foiled by the FBI as 4 alleged members of a radical pro-Palestinian extremist group have been arrested. Wow, that's scary, huh? I don't jeez, man. Ugh. Hate that. I hate hearing about that. I mean, just terror. It's just terrible. Anyway, okay, let's focus right now on what we've got. So we've got the Qs selling off. It's actually very interesting. This morning, the market was quite green. You know, a lot of people are like, hey, we're going to get a big rebound today. Is today buy the dip? And I'm like, do not trust the pre-market. Never trust pre-market and the futures. You must instead watch for something very closely, which we'll talk about in a little bit. Yeah, I mean, this is all tanking right now, tankly doodling, which isn't great. Across the board, I mean, I've got red all across the tape here. This is insane. We got Ethereum back under 3,000. I think that means we have another opportunity to buy Bitcoin under 90,000. Wow. Yeah. Would you look at that? What's actually interesting, I tweeted something on Friday, and I think a lot of people didn't really pay attention to it, but that's okay. I'm going to find it. No, it wasn't my post about the mold photo and the Bitcoin. Instead, let me grab it here. Here it was. All right. Trump says Kevin Warsh is now a pick for Fed chair. This is bearish and should be. If markets tank on Warsh, Trump will flip on him too. Waller is the best answer. So I tweeted this at 1 p.m. on Friday. And now we're seeing some of that red here. Kevin Warsh is seen as somebody who has a history of, being a little reluctant to bail out markets when it goes into a recession, which a lot of people are like, good, let it crash. Warsh, 2008. Let's see if we could get like a story of Warsh. So, primary, let's see here. Okay, in speeches and meetings during 2008, Warsh frequently noted a pullback in the willingness to engage with the other market participants. That's fine. Where is his own policy reluctance? Warsh was known for a hawkish stance on inflation. In 2008, following significant rate cuts, he argued against further reductions. Let's see here. I want to see what other arguments there are here from on Warsh. In later reflections, he has implied that an excessive focus on inflation risks during that period may have been a misjudgment, given the scale of the financial collapse that unfolded. So, yeah, I mean, think about that for a moment. So, I'm actually going to retweet that because it's very interesting. Okay, so, here we go. Let's go put this all in here. So, we'll go Fed. And let's consolidate some notes here because it's all related to kind of what's going on now with also the chip sell-off continuing. So my Friday market close message. And then, of course, I have Kevin Warsh. So Kevin Warsh. I have mentioned, and I want to be clear about this, I've mentioned my favorite is Waller for months. Least favorite is Warsh. And Hassett is a shill. So, like, I guess I could kind of in order, like, put Hassett here in the middle. Hassett is a shill, and Warsh is the worst. Warsh has admitted that he was too hawkish on inflation, advocating for fewer rate cuts in 2008, admitting this was a misjudgment given the magnitude of the financial crash. This creates some nervousness, in my opinion at least. Markets are nervous. Warsh equals hawk, and he won't actually save the market if we tank, like Powell or Waller or Hassett might. So, like, he's probably the most aggressive out of all of them just based on that historical experience. Now, Myron this morning, Myron's yapping up as long as housing disinflation continues, keep cutting to get to neutral. So he doesn't think we're there yet, right? And then Fed Williams is speaking right now. Fed Williams just said, we are well positioned now. We are, it's critical we get back to 2% inflation. We are at neutral. Okay, let's throw in some grammar here. There we go. Fix that. And then he says, Williams are one-off, not a spiral. Tariffs. Tariffs are one-off, not a spiral. Okay, so that's interesting. Hi, Jack.
Hi.
Don't say that at an airport.
I got you to say it on airport.
Yeah, you did get me to say it at an airport. That's a good point. What are you doing today? You gonna go to work?
I hate work.
You hate work? Yeah, the worst part about your work is you don't even get paid for it. That's a scam. They have you solve all...
Everything you have to pay for it.
I know, we have to pay. We have to pay for you to go do work. It's like you have to solve their math problems. Like you're not even getting paid for solving their problems. Every day, the teachers give you all their problems, and they don't even pay you for it.
Why is it called a problem?
Apparently they have issues. A lot of issues, and they rely on you to save them. Well, that's very charitable of you. Good for you, buddy. You're gonna save the world. Okay. Anyway, so here's Warsh's speech. Late in the fall of 2010, when the unemployment rate was near 10%, inflation was 1%, Kevin Warsh stood before the annual meeting of whatever to critique the Fed's action of saving the economy. The economy's true ills were structural, Warsh argued. In his view, the Federal Reserve actions could paper over these deep problems, but do little to change the economy. Contrary to Warsh's warning, the Federal Reserve went ahead with its plan. Today, the unemployment rate is at 4.3% and inflation is below. Right. So this misjudgment goes beyond a simple policy error. Even the best policymakers make mistakes. Warsh's error, however, was indicative of a broader mindset, one that has devastating macro implications. Holy smokes, Dylan, that's awesome, dude. Thank you so much for the $50 donation. Just bought the course. I know it's late, but you helped me turn $30,000 into $109,000 with your open door calls. Dude, let's freaking go. That's awesome. Congratulations. That's a huge money shot, a moonshot right there. Congratulations. Thank you so much for that. Oh, yeah, buddy. I get quesadilla tip, too. Thank you, sir. Oh, it's so good. This one's made with love. As it turns out, both the Eurozone and the United States had an unemployment rate near 10% in November, right, of 2010. Mind you, also, I haven't really mentioned it much, but we do have the Santa coupon code up. So if you go to meetkevin.com and you hit the join now button, you could use the coupon code. Thank you so much. Goodbye. Oh, what is that? Who is that?
You guys will know what this is, probably.
We'll see. We'll see. I'll let you know if they know.
Okay.
We'll see ya.
Bye.
Bye. All right. Anyway, yeah, we put the Santa coupon code up if you want. You get all of the library of courses, trade alerts, every private live stream. Mind you, what we said this morning in the Alpha Report, I said, don't trust the futures. We could continue this sell-off of rotating out of hardware stocks And I specifically called out the bag holders of CoreWeave, NBIS, IREN, and Oracle. And I kid you not, look at what these puppies have done since open. CoreWeave tanked. NBIS tanked. All since the open. Okay? Even NVIDIA just went red. Where was it? So there's IREN, CoreWeave, NBIS, Oracle. All of them tanked off the open. Even though futures are green and people are like, oh, futures are green. Pre-market's green. It's all good. I'm like, I don't trust it. Don't trust it. The sell-off could continue. And you know, be warned. Just watch. I said, watch the first 5 minutes. That's all you need. And you're going to see. If it falls off a cliff again, there's your warning sign. And sure enough, we did. So, you know, those are the kinds of things that we do in the Alpha Report. Look at that. We're down 32 bips right here on the Qs. But anyway, going back into this here. So the unemployment rate was around 10%, citing concerns similar to Washington. The ECB decided not to pursue quantitative easing. The result was disastrous. Oh, wow. They compared to the sovereign debt crisis of the ECB, who basically took the Warsh approach. The result was disastrous. By 2013, the Eurozone unemployment rate had climbed to 12%, while the US was at 8% and slowly recovering. Japanese stock and real estate bubble crashed in 91. The economy entered a long recession and weak recovery reminiscent to the US and European experiences after 2008. The Bank of Japan likewise cited structural impediments to growth. Ben Bernanke criticized Japan for a self-induced paralysis and the unwillingness of monetary authorities to experiment. As fortune would have it, when the global financial crisis struck in 2008, Bernanke was chairman of the Fed. Despite criticisms both inside and out, notably from Wall Street, Bernanke was not content to blame the crisis on structural factors. Instead, he adopted extraordinary ranges of atypical monetary policy devices to battle the crisis. Wow. Since leaving the Fed, Warsh has continued this line of criticism in the face of overwhelming success of Bernanke. Unemployment is record lows. The economy has completed a record string of job gains, blah, 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 blah. Should we face a major shock now, a banking crisis or a sustained spike in oil prices, we may be forced to return to this type of creative activity from Bernanke used, basically. Money printing, essentially. We will need a Fed chair who has the judgment to know which levers to pull. Given his record during the last crisis and unwilling to recognize his mistakes, Warsh's nomination would leave us more exposed to a lost decade. This is a risk the U.S. economy cannot afford. I totally agree with this, by the way. I don't like this guy at all. Even before I read this, I didn't like this guy at all. That's why I tweeted this on Friday. So Kevin changes of it. I actually don't change my opinion very often. If you watch my live streams, my course member live streams every day, you know, on a regular basis, we're updating the Bear Bull scale. And we've been teetering around 5 for a while. In other words, we're at like this, or slightly above 5 even. We're at like a cautious optimistic place. You know, that number doesn't change very often. It's pretty damn stable. We're cautiously optimistic, but we recognize the risks. You know, we think the Oracle bond sell-off is a problem. It's going to make it more expensive for people to finance data centers. And, unfortunately, as the hype wave dies and, you know, you get companies like IREN and CoreWeave and NBIS that tanks, all it does is send a message to lenders that these are more risky to invest in, right? Sorry, right? Michael writes, love the reinvest video yesterday, red tape and everything. Yeah, exactly. Well, thank you for saying that. Yeah, it's incredible. We got that fundraise ending in 16 days. But that's over at househack.com or reinvest.co. You got to stop raising money at the August of 24 valuation. But we actually think it's a great way for people to diversify. But obviously, you have to evaluate that yourself. Read the offering circular. This is not a solicitation. But anyway, going back to this stuff, as these companies, these hardware companies tank, you have to realize it becomes harder to raise money. And it's actually funny because I have at the bottom of my alpha reports, I have like a do not delete section that I've had, and I've had this there for months. But what I wrote is that CoreWeave, NBIS, Oracle, and IREN, these will be the bag holding companies. And these are very bearish for the longer term. So I've been very bearish about those companies in the longer term. You know, there's short-term swings that you could play off of lines, but I think sometimes there are people who don't pay attention to what I'm saying. So you get these knuckleheads that, you know, they don't, they're like, oh, Kevin's changing his mind. Really? Like, tell me when I've changed my mind, because I've been really consistent. I think what they do is they just read titles. They're not really paying attention. And really, it says more about them than it does about us, because we're very clear about this on a regular basis. You know, the Federal Reserve is printing money to try to prop up these very data centers. The problem is, and we talked about this in the alpha this morning as well, is it could be pushing on a string. You know, if the Fed is trying to pump money in, but it doesn't actually show up, then unfortunately the problems continue. But let's keep going here with the Warsh piece. So we saw that piece from Warsh. That was very interesting. Then I've got over here, Warsh. Let's see here. What is this? This was 2025. Fed contender, Warsh. Warsh called for higher rates even during the depth of the financial crisis. It's incredible. It's incredible. You know, this, like, it's so incredibly stupid. And the guy refuses to acknowledge that he was wrong then. But anyway, this is a concern. Max says, how Carvana? Well, like I said, you know, in order for Carvana to go down, you actually need, ironically, the stock to go down. As long as the stock goes up, the stock keeps going up, because they can finance the purchasing of these receivables and artificially prop up their earnings. All right, so Warsh called for higher rates even in the depth of the financial crisis, warning of impending inflation. That's a concern he's reiterated as recently as this year. Warsh has become an enthusiastic supporter of lower borrowing costs. His transformation comes at a time when President Trump demands the Fed cut rates. Blah, 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 Warsh becoming, but now you're right. So, okay, fine. So we know that. Fed policy, the Fed has the policy mix exactly wrong. It has a big balance sheet like we're in a 2008 crisis or pandemic, and has rates that are now too high, okay? It needs to shrink the balance sheet and cut interest rates. How? How do you, like, the Fed is doing the opposite right now. We're cutting rates and we're growing the balance sheet. So, I think this guy's a terrible pick for Fed chair. It's very scary, and I think it should scare a lot of people. This guy would be the worst Fed chair. Beyond cutting rates, Warsh has, because he's basically saying, yeah, let's keep quantitative tightening going. Yeah, okay, that's great. Very great. Warsh has plans for sweeping overhaul of the institution and reimagine everything from how the Fed thinks about inflation to its staffing levels. Fine. Warsh has lamented the central bank's multiple bond buying programs, especially those conducted outside the financial crisis. He resigned from the Fed in 2011 after Bernanke basically kept going with QE infinity. Now Warsh says that reducing the balance sheet, which would put upward pressure on actual borrowing costs, would allow the Fed to move the other way. Yeah, that doesn't make any sense. Four months later, the global financial system nearly collapsed when the housing bubble burst. At that point, Warsh voted with his colleagues to cut rates to zero, but by September of 2009, with inflation in negative territory and unemployment rising, he said the Fed may have to raise rates with greater force in the future to combat inflation. Oops. The Fed didn't raise rates for another 5 years, and inflation averaged 1.5%. The guy's a knucklehead, man. Total knucklehead. So I hope we don't get this clown. Okay. This is paywalled. Great. Fantastic. All right, no problem. All right, what else? So let's take a peek over here. Do we have any recovery yet in the Qs? Yes, we are bouncing off a 609 in the Qs. We are now at about 15 minutes of recovery. About 15 minutes of that, at least. You've got Iran still down about 9, and stabilizing, though. All three of these are stabilizing a bit. Q's trying to come back. Sell-off is slowing down on Bitcoin. And broadly, most things right here. Back to 3,000 on Ethereum. We were just under 29 there for a moment. All right, cool. Let's see what we have. Let's go pop open some of the news. But yeah, anyway, thank you to all those of you either investing or emailing in HouseHack before the fundraise ends. Investment approved for payment. Oh yeah, we got a lot of these. That's that. Oh, perfect. Okay, that's good. Yeah, I mean it's Oh, cool. Okay, cool. All right. Let's take a peek over here. All right. Yeah, I know everybody's kicking butt. All right, good. So let's go see the news now that we've got El Newso. Okay, son was arrested after director and wife found stabbed in their home, being held on $4 million bail. This is crazy. Maybe the son needed some dollar hollers or something, but to kill his parents, it's sad, huh? That's crazy. Oh, that's sad. Search for brown gunmen after they release the person of interest. That's not great. Charges are expected against surviving Sydney shooter, Syrian-born Australian, who tackled one of the gunmen, is recovering in a hospital. That's the people have made a GoFundMe for him, by the way. All right. Trump cuts to U.S. Labor Board leave festering disputes. Oh, let's take a look at this. Okay. Turbulent times for Mertz. Yeah. Okay. So let me see here. This is the agency charged with overseeing the U.S. labor relations. Overseeing U.S. labor relations has been largely sidelined for the past year, mired in legal limbo that has delayed the handling of major cases. National Labor Relations Board for months has merely had a single member on its 5-seat board, too short of the 3 required to hear cases. Inability of the board to function last year shows how broken the system is. Non-functional labor market. Yeah, go cut everything, I guess, has been the sort of idea. And any kind of regulation kind of gets cut under Trump, I guess. All right. Cool. That's kind of boring. Let's see here. Bitcoin investor plans Caribbean court system. A Caribbean community with its own court system. Blockchain court? The public can vote. That'd be cool. Brussels to scrap 2025 or 2035 combustion engine ban. That doesn't surprise me. Everybody's slowly been kind of U-turning on what's it called? Electric vehicles. Fed decisions are distorted by phantom inflation. I'll have to look at that. Let's see here. Okay. Investors will have to wait for the new year for clarity on the economy. Yeah, I mean, we do get data tomorrow, but remember, Jerome Powell told us that data is likely rigged. So I find that very interesting. Let's see here. Phantom inflation. Fed Reserve Myron said that phantom inflation was distorting the central bank decision-making and causing interest rates to stay too high. Interesting. Let's see here. Kevin, will HouseHack just have keep trying to generate more money to buy properties for HouseHack? Yeah, well, we're going to stop our fundraise because we actually think that if we just go all in right now on, the development pipeline that we have for our artificial intelligence, we actually think we can make so much money that we'll have plenty of money to go buy real estate with just the money that we get from the development phases. We're basically releasing the alpha access to the app here in 25 this month. And then we're going to get to like public data, beta access, the valuation AI, renovation AI. Like all of these are going to be really, really important for really making this app robust and scalable. And we think we can generate, hopefully, I mean, based on what we've seen so far, we think we can generate so much revenue from the AI product. I mean, hopefully, people are buying the lifetime access right now, which is really amazing. People keep buying it over at househack.com. But we think even as the features come out, that just accelerates, and we'll just use that money to buy real estate, and then we don't have to raise money. Fundraising's a pain in the butt. There's a lot of compliance and work, and I always got to do the this is not a solicitation. There's risk with every investment. Make sure to read the offering disclosure. There's a lot, but it's a good question. Fed decisions distorted by phantom inflation, says Myron. Yes. Okay, so, let's see here. Staunch ally of Trump, policymakers should disregard near-term price distortions and set borrowing costs for the long term. Yeah, that's fine. That's an okay way to put it, right? Okay, this same person spamming in the chat the same thing over and over and over again. See ya. Okay, so we must be thoughtful, and Tom from MySpace. What's up, dude? I saw your comment about what the stars were. Has anyone tried to get you for not disclosing on YouTube? No, we're actually pretty good. I think it's just because I've gone through so much training with FINRA, going to the FINRA advertising conference, seeing what they look for, seeing what they enforce for. I think we're probably one of the best when it comes to actual disclosing, this is a paid partnership, this is a paid promotion, read the offer. We're pretty good. This is not personalized financial advice, right? I think my disclosures are pretty damn good on the channel. We must be thoughtful and genuinely considering underlying inflation pressures, excess inflation, Fed is cut, blah, blah, blah. Myron said the Fed was overestimating the current state of inflation. Yeah, he's probably not wrong, which is probably exactly why you don't want WARSH, right? So I'm going to make a note of that. This is why you don't want WARSH. Why you don't want WARSH. Because he's going to come in and do the same thing he did the last time and think that inflation is, the end of the world. So, crazy. Let's see here. Investors will have to wait until the new year for clear data on the economy. Investors looking forward to long-delayed data releases this week might have to wait longer for clarity on the state of the economy. Yeah, 2 reports from the BLS will provide the best read on the economy after the shutdown, but analysts warn the delayed statistics will be tarnished and only provide limited clarity. Yeah, it's not just analysts, but it's the Fed saying this, right? Let's see here. We're still in the clouds, and the data we're going to get is better than not having data, but it's not definitive, because the economy is in flux. Yeah, sure. We're well positioned to see how the economy evolves, blah, 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 blah. Buy gold and silver and mining stocks. Nah, I'll keep buying real estate. Oh, that reminds me. Did that guy want to chat? I'll wait. Yeah, I passed on a deal, which I was really grateful on, because I had a feeling we weren't going to get the deal. And then, there were 2 deals I wrote offers on. Well, actually, no, I didn't write an offer on the second one. One deal I was looking at, I'm like, this is ridiculous. What happens in December is there's so little inventory on the market in December. December is usually the worst month in Q4 to buy real estate. So we bought most of our real estate in October and November because that's when inventory is higher. Then inventory goes down in December, and there's so few deals, people start paying ridiculous prices. So I was going to write an offer on one, and I told the agent, hey, like, no, this is getting too ridiculous. So I passed on one. Another one, I'm like, I hope I don't get this because, like, it's getting a little ridiculous. It's okay if we get it here, but I'd rather not get it. And so I didn't get it, and I had a feeling I wasn't going to get it, otherwise I would have withdrawn my offer. But what's funny about it is, as soon as they go take another offer on Thursday, which I remember when I got the news, I'm like, oh, good. I didn't really want it anyway. When I got that news, I ended up getting a message after that. Hey, Kevin, I got this last night. Are you still interested? The deal fell through. And then I go, well, at least they let you know fast because they were only in escrow for like 3 days, right? I go, bummer, possibly. What happened? Did their Bitcoin go down? And he goes, they're twats. Gave some BS excuse about going back for a second look and complained about water damage. And then I reply, I go, the house was literally actively leaking when people were looking at it. Like, how do you complain about water damage when the house is actively leaking and dripping? It's just a scam. So anyway, where were you? Where were we? So going back over here. But anyway, yeah, no, I'm not gonna hop on the meme path of the gold and silver trade right now. So, but anyway, on the other hand, stronger rates, classic. Yeah, I mean, anyone in real estate knows it's such bullshit. Okay, good. So, on the other hand, a stronger reading would make weakness look temporary, but inflation data would be less complete. Yeah, the data is going to be less complete. There's no doubt about that. So you're definitely in a little bit of a fog right now. Classic, please buy this now that the buyer ran away. I know, like, I'm going to have to lower my price, which is exactly what I do, is I'll just tell them, like, hey, man, like, I'm not as excited about it anymore. You know, take 30 grand off and I'll give you a non-contingent offer. So, okay, good. Ken Macro. I like Ken. Ken's a good guy. I don't like multifamily, though. We own multifamily. I don't like multifamily. I'll tell you, single family is way better. Okay, so The Economist. Job apocalypse. AI is creating brand new occupations. Well, that's what Sachs says, but I think he's a Sachs of you know what. Let's see here. Description, stay by servers and unplug them if things turn on. Wait, what? A mock job advertisement. Kill switch engineer. Oh, okay. Okay. Technology is already creating demand for new jobs to train agents, embed them in the organization, and ensure that they behave. Yeah, I mean, this is like a CRM or a Salesforce, right? CRM, Salesforce, or UiPath, I should say, Path. You know, that's really what these plays are right here. So, let's see here. Start with data annotators, no longer lowly paid gig workers, tagging, AI's advanced experts, enlisted to train models, blah, 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 blah. Once bots are trained, teams of so-called forward deployed engineers are required to embed them in organizations. Palantir has pioneered this concept. At the beginning, it was just us. Blah, blah, blah. Go there and win. Right. Now you could use... yeah, okay. Basically, you're trying to deploy AI into functional places. I mean, this makes a lot of sense. Yeah, I guess the question is, how many people do you have to hire for these jobs? Let's see here. Data does not leak. Yeah, okay. I mean, this is pretty basic Economist article here. All right, what's the information got for us? Somebody says, Hims gave me depression, bad. Well, what's wrong with Hims? I haven't looked at Hims in a while. I know they memed there off the... the problem with Hims, and I've said it for a while in our alpha reports, is that the commoditization of the GLPs isn't good. Everybody's fighting to get people on GLPs, and a massive income set comes from these. Now, they try to brand themselves as anything but GLP plays. And so they have actually gone into this massive campaign for promoting mental health pills for women, especially, to take on like TikTok and stuff like that. And I think that's playing a very dangerous line, like trying to go from the GLP subscription, which was very high margin for Hims, and led to a lot of momentum in the stock, to mental health drugs that are, in my opinion, I think a lot of people taking these mental health drugs are misdiagnosed, and they need to go touch grass. And I'm not saying there aren't mental health problems in society, but I think it's you know, if you're using TikTok to diagnose your mental health problems, you're probably mentally screwed because you're on TikTok in the first place. So you're almost like shooting fish in the barrel. Imagine that, you're selling mental health drugs on TikTok, where the very platform creates mental health problems. Whatever. People running Apple after the exodus, whatever. When will we reach AGI? Don't care. It's gonna be a long time. Huawei, blah, blah, blah. Okay. Boring. How's our 10-2 today? Wow, we're at 66. So, what's Politico up to? Let's see here. Democrats unite. Is that what they're trying to pitch here?
Joining us on set at the New York Stock Exchange. Morning and welcome to Money Movers, everyone. I'm Sarah Eisen with Carl Quintanilla, live from.
We're just doing a little recap. All right. Trump suggests Rob's death was due to Trump derangement syndrome. Oh my lord. Likely the result of anger he caused others through Trump derangement syndrome. Stop. Oh my gosh. Rob, a tortured and struggling but once very talented director and comedy star, has passed away together with his wife, Michelle, reportedly due to the anger he caused others through his massive, unyielding, and incurable affliction with a mind-crippling disease known as Trump derangement syndrome, sometimes referred to as TDS. Yeah, leave it to Trump to immediately make it about him. That's terrible. So let's see here. What is this? The new CNBC logo is like stupid. I know, yeah. Like this is what a terrible logo. Like it's absolute ass. Like I actually thought their old logo was good. This new logo is so bad. I hate it. Sorry. I can't help myself but share my opinion. I say, you know, it's actually a thing that I always say is if I'm not complaining, it's a good thing. It means there's no problem. So, but if there's a problem, you're gonna hear me bitch about it. And you know, I say this to my wife Lauren too. I'm like, look, if I'm not bitching, then there's no problem. You know, or like my team, if I'm not complaining, there's no problem. Because if there's a problem, I will bluntly tell you about it very rapidly. So, anyway. Okay. So how are we doing over here on the stinks? The sticks. Okay. So, what do we have? Let's see here. We've got Apple. Ooh, just right below the line. Look at the lid. Still struggling, like you're still just hanging out low on these. Kind of just the slow drip right here. No support. I got nothing in this region for the Qs. Let's see here. Yeah, everything is getting hit. Bitcoin, another chance under $90,000. Meta is actually slightly green today. That's crazy. GameStop. So Kevin, with sign are you? Aquarius? Okay. Kevin, I can hear the children crying in the background. Noise reduction is not good. It's because the door is open. You know why? This Myra Trader person, why is it all you do complain? All you do is come in here and bitch. Like, I literally saw your comment like 2 minutes ago. You're like, oh my gosh, Kevin, you're shitting on TikTok. Why are you anti-China? It's like, are you retarded? Like, when did I say I'm anti-China ever? I think China is literally delivering the world a service of deflation across the world. Because I use TikTok as an example because that's where they specify, where him specifies is their social media outreach. That's where I saw the examples. That doesn't make me all of a sudden anti-China because I shit on TikTok. I think TikTok is brain rot. Good Lord. And now it's like, oh, Kevin, your office is broken because I hear a baby scream because the door is open, dumbass.
For more on the widening bond yields for Oracle and some of these other hyperscalers, which appears to be hurting the stock.
Yeah, and it's clear, Sarah, that the market is becoming just more aware of how these hyperscalers are spending money, especially debt. As it pertains to Oracle, the key question is whether the company can raise mountains of new debt while holding on to its investment grade credit rating, currently at BBB, the lowest of all the hyperscalers. Last week, Oracle's management did reiterate its commitment to IG status, but the yield on Oracle's tenure is telling a slightly different story, now widening to above 200 basis points, while its 5-year credit default swaps remain elevated on this belief that if the company raises a term loan from a consortium of banks, those banks will then have to buy Oracle CDS as a hedge. Starting to widen. Roth Capital Partners in its morning note today calling out the uptick in CoreWeave's CDS. Bank of America strategists separately write that hyperscalers like Meta, Amazon, Microsoft, Google, they generate enough cash flow to fund CapEx, but are also tapping the debt market to maintain flexibility, optimize the cost of capital. Of course, we've been watching that over the past couple of weeks. The key, though, they add, will be off-balance sheet structures and to look for mentions of vendor financing, which does involve the use of chips as collateral. We are watching the bonds of Meta. Spreads are widening slightly to 118 basis points versus 115 a month ago. I would point out that Microsoft bonds have tightened, the same with Amazon. So it is sort of evident of how investors are being more selective as we follow this debt story closely, guys.
Meantime, it's hard to talk about the CDS, Seema, without talking about the equity. And Oracle, in the last, say, 4 or 5 sessions, is down almost a clean 20%.
Right. I think now down about 40% from its recent high. Clearly, there is opportunity here for management to level set the expectations around debt financing, just how much it's planning to raise. According to a credit investor I spoke to on Friday, the expectation is that this is a company that needs to go to the debt market sooner than expected because the latest 10Q did show a substantial rise in data center leases, which, again, resurrects this whole question around financing.
Seema, thank you. Seema Modi
there it
watching
is.
all the
That's
hyperscale.
Huge, mind you. What's happening with the Oracle debt? I mean, the Oracle is. I want you to see the CDSs, okay? I just went in and I pulled up the CDS chart. This is bad. I just needed to download. Here it is. I just pulled up the chart on the Oracle CDSs. Bro, what the hell? Holy smokers. Oh my gosh. It's like, remember last week? I'm like, oh, the numbers haven't updated yet after earnings. They just did. Holy smokes. Folks, this is crazy. I mean, this is obviously like, you know, over at 130, they were worse than 2008. Okay? So let's write this down. So 24, come on. 24? Yeah, that's right. All right. So in Friday's alpha, Kevin said, expect chip sell-off, chip hardware sell-off to continue. And it did, right? In this morning's alpha, I said, don't trust the pre-market. Monday morning, don't trust the pre-market green. Hardware sell-off, keep going. It did, okay? Now, we have to consider this. I was, this weekend, I was looking at, who was it? Homeboy. We were exchanging some tweets here. Oh, replies. Where's Homeboy's tweets? Okay, so Homeboy says long-dated bonds down 12 points already after 18 billion issued, has to slow down, not enough demand, 10-year down 5 points. We'll have to raise the coupon going forward to be attractive. So this is basically Homeboy indicating that, you know, the bond premiums on these are evaporating. So basically, let's write this down. This is, you know, the CDSs crossed 2008's level at 130. They're at 148 now. On top of that, long dated, so 5 and 10-year bond premiums are falling. Oh, I should put that parenthesis right there. There we go. The premiums are falling. And the problem with the premiums falling is not only are we right, special situations right in that you'll have to offer a higher yield, but what does that do? That increases cost to sustain continued borrowing, which is bad. And mind you, they just this weekend just reported 150 bill in additional leases. That just scared markets even more. You know, remember what they said in their earnings call, okay? They literally said, bring your own chips. Did you hear that? Like in the Oracle earnings call, I covered it. Let me see where I put it. Stonk tab. Let me go to Oracle here. Pretty sure I have that written down. Oracle, course members. Here we go. Oracle. Fed's basically saying they're too big to fail. That's true. We got a crop load of debt. Where did I put the chips? Bring. Can't find it. Bring your. I don't know where it is. I'll just pull up the earnings call again. Somewhere they talked about bring your own chips. And I thought it was hilarious when I heard it. So I'm gonna pull our earnings call right now. Oracle financials. No. Come on, weenie. Earnings. No. Events. Here we go. Earnings call. Got it. All right, watch this. This is so ridiculous. Because that's basically a way of them saying, yeah, we don't know how to make the market happy with all the spending we're doing, so we're going to pitch bring your own beer. We're so broke, we're doing bring your own beer for chips. Oracle earnings call. You can't make this stuff up, guys. This is just hilarious. And that's why I want to show you the proof, because the proof is in the pudding. All right, come on. Open. All right, here we go. Let's see if I can find it. Bring your, oh, come on. Bring. There it is. There it is. In addition, there are some other financing options through customers that may bring their own chips to be installed in our data centers, and suppliers who may lease their chips rather than sell them. In other words, don't expect us to go buy it all. People will bring their own chips. When I heard that, I just about vomited. I'm like, there it is. See, like this. Let's see here. But this is far more capital intensive, unlike any other business Oracle has ever been in before. Like, hey guys, this is expensive. And then the response from the CEO. Okay, CEO. Don't worry, bro. We're doing bring your own chips. AKA brokey. Only bring your own beer equals brokey. I mean, in fairness, like, bring your own beer because, like, it is expensive to fund a whole party. But, like, if you're supposedly rich, you don't say bring your own beer. You say, come to my house and have my beer. Hold my beer. You know? One of them is that customers can actually bring their own chips. Oracle, that way, doesn't have to incur any capital expenditures that way. So we'll just run the business by letting people bring their own stuff. And they pitch this as like, oh, we'll just be chip agnostic. You know, it's like, chip agnostic? Nah, bro, we just can't finance anymore. Bond market pissed. That's really what's going on here. So, like, when you see that in the earnings call, it's no surprise. I've been shitting on this in the alphas. It's crazy. Anyway, let's see. Okay, CoreWeave and yeah, I'm gonna paste a quote in here, literal quote. That has been here for 2 to 3 months. Literal quote in my alpha reports since, I want to say like September, October, somewhere around there. Literal quote right there. CoreWeave, NBIS, Oracle, IREN, ETC. The writing is on the wall. These will be bag holding companies. You know, that's what we've been saying. Anyway, like this whole bring your own chips thing is insane. Oh, GameStop's doing really nice right now. Look at that. GameStop popping off. Good job, GameStop. But anyway, yeah, I mean, look, CoreWeave since October has literally gone from 137 to 74. It's almost halved since October. Look at IREN. IREN, literally top of the market. I get people asking me, Kevin, should we buy IREN? I go, this is gonna be a bag holding loser. Look at the double top, bro. You know, NBIS. Like, and I'm not trying to say like if you have money invested in these that you're wrong for having made money. No, you're right. Like the data center boom was great. Just saying, now when we look at the credit default swaps and what we're seeing with the bond market, it's a little poopy doopy right now. Just a little poopy doopy. Okay. Okay, so I don't have to bring my house hack chips to your basement. I already have my house hack chips in my basement. Actually, I don't have a basement. We do have some Blackwells. They're great. But we, you know, we actually don't have to use data centers as much as people think for our AI because, you know, we can analyze properties really like one time and then serve that answer multiple times to, you know, paying customers. Like, rather than running your servers every single time for a ChatGPT query, we could answer, you know, 1,000 queries one time and then feed that answer, you know, infinitely. It's actually kind of interesting. Somebody says, bring your own seatbelt because we're going for a ride. Hell yeah. Leaf blower people are back, so we're going to turn on the audio filtering here. Okay, I always love it. The leaf blower people always show up right in the middle of my live streams. Somebody says, hey, Kevin, would you take tax loss on new positions and look to rebuy in Jan-Feb? Well, I mean, I wouldn't mind taking tax loss harvesting on if I had losses in longer term positions. I wouldn't mind playing that. Would I try to trade it? Probably not. Like anything that I have on my 10-year list to buy, don't even look at is my POV. So we have this list of 10 stocks that I'm just like slowly allocating money to. Very little. You know, I just sold like, I don't know, what was it, $2.5 or $3 million worth of stocks. And, you know, I bought back a few $100,000 in new names that I want to really acquire over the next 10 years. And the whole point of the list that I've been saying to course members is like, if the economy goes into recession, I don't really care. Like, I'll just keep buying on these 10-year names because I want to hold them for 10 years. And so my allocation is relatively low overall to them relative to what I've sold. So I feel like I've already done my selling. But no, I'm grateful for what we've done. Okay, hey, look, the Qs went positive again. That's nice. So what's driving the Qs going positive again?
Gain the lead.
It looks like Nvidia's recovering and AMD recovering. Obviously, Tesla's doing well. And looks like a little less pain over here. Yeah, it looks like you got sort of a broad recovery, which is nice, intraday at least. But let's see here. Let's go into, so it says, what's the fair value of Oracle? Well, I mean, technically, if you base Oracle on a PEG basis, it's very, very, very cheap right now. So if I go to the stock tab for course members, I have them valued at a 0.87 right now, which suggests they could be selling for a lot more than what they sell for now. The problem is, the PEG ratio, you have to understand, the denominator is growth. And if growth turns negative, it's over, right? Like, it's all gonna go to trash really fast. So you're gonna have real problems there. Okay, good. So that's a bit on Oracle. We'll touch more on that in just a moment. Let's see here. Okay, that was the Oracle survey here. Let's go check out what the Doomers have for us this morning. All right, so the Doom and Gloomers. Let's see here. Jobs tomorrow. McKinsey plots thousands of job cuts in slowdown in consulting. Well, that's not a surprise. Let's see here. Mass shooter manhunt. Detainee released. That's the second time they've arrested the wrong person. Bulletproof cars are a booming market in Brazil. Oh man, why didn't you move out of Brazil then? Well, that's sad. I've never been to Brazil. I would like to go to Brazil, but not any bulletproof car. I don't know, it's a little sussy baka. All right, let's see here. So what do we have? We have McKinsey. Partners gathered in the consulting giant birthplace in late October. Bob Sternfeld delivered a rallying cry. We will kick some ass with the start of the second century. Okay. All right. That person's getting hidden. Goodbye. Somebody's literally spelling out racial slurs in the chat. Like, don't people realize, like, the chat that we have is, like, the most moderated chat, I feel like, on YouTube? Quick mod, that was me. Okay, but yeah, usually y'all are pretty fast, but I think I gotta jump on that one. Anyway, we will kick some A-double when we start our second century. The firm's top executive told thousands of attendees. This was in late October. Okay. Told thousands of attendees. But away from the 100-year festival in Chicago, McKinsey bosses have been conveying a more pragmatic approach. It's time to get leaner. Wait, so you're telling me that the suits told all their employees, hey guys, we're gonna kick butt, we're going to the moon. And then behind closed doors, they're like, actually, we gotta fire a lot of them. Man, that's just scum, dude. That's scummy. Firm's leadership has discussed with managers and non-client facing to cut about 10% of headcount, according to people with knowledge of the matter. That could amount to a few thousand jobs over the next 18 to 24 months. Wow. Wow. Yeah. All right. Well, that doesn't surprise me. All right. Let me go grab now. I have an Oracle analysis. I will pull it up. Let me see. Oracle earnings presser. So, you know, if I actually look at the Oracle numbers, their margins are compressing, but they make a lot of money. But a lot of this money is driven by CapEx spend, right? The reason their net income is popping off is because of the balance sheet explosion. So this plant, property, and equipment side over here, the PPE side does generate actual EPS growth. So this is like buying real estate. Of course, your EPS is going to grow when you buy more real estate. The question is, were the acquisitions good deals? Even a bad deal contributes to EPS, right? Like, people got to remember that. You could buy a crap deal and your EPS goes up. But if the underlying goes down, you know, it can still generate yield, but it doesn't mean that your plant, property, and equipment expenditure was good. So then if I go to here, we currently have $136 billion of debt. That's 7 years of operating cash flow, okay? The problem is, oh, let me look at what the forecast is. The problem isn't the forecast of EPS, of earnings. By 2030, markets expect Oracle will have net income of $60 billion per year. They could pay off all of this debt in 2.5 years and be debt-free, right? So, like, the problem isn't the forecast. The problem is, are we actually going to get there? Bro, I need more coffee. This is ridiculous. Let me see if I can put it in an order for coffee really quick. Hold on. 1 sec. And then let's also pull up these forecasts. Hey, would you mind bringing me a coffee? We'll see. That works like 30% of the time. Okay. All right, so if I go to Oracle, and if I go to a financial analysis on Oracle, what I want to look at is I want to look at plant, property, and equipment growth. So if I go to balance sheet forecasts, so do we have balance sheet forecasts? No. All right, well, what good is it then? Key stats. Yeah, that's actually interesting. How are people not forecasting their plant, property, and equipment? They have to. They don't. Plant, property, and equipment. I might get until 2027. There we go. Plant, property, and equipment forecast for 2027. I have plant, property, and equipment expected by 2027 to get to 136 bill. There we go. And it doesn't go any further? I thought I'd be able to get some kind of forecast. Oh, wait. Oh, no, I can't. Wait. Okay, to 2030. I think I got it. Plant, property, and equipment. Oh, yeah. All right, there you go. Okay, so the problem isn't the net income forecast, right? I'm going to write this out for you. Wall Street's PPE forecast, right now, we're at 67 bill, right? 67 bill now, and that's 67. It's going to become 86.5. 86.5 in 26. Then that's going to become 136 in 27. 191 in 28. 241 in 29. And 272 in 30. So, in other words, in order to get to that net income, okay, to get to that income, we need to add about 205 billion in debt, okay? That's why the bond market is freaking out. Where is that money coming from? Okay? So that's why I say the Fed pushing the string is a problem. The Fed pushing a string is a problem. That's the problem. All right. So I just realized I've never seen Kevin drink water. Been here since 2020. Really? That's crazy. All right, so where were we? Okay, here we go. Oh, thank you. Cozumel cup. Actually, where did we get this?
Cancun.
Cancun cup. Thanks. All right. Coffee's been delivered. All right. So, where were we? Let's see. Coming up, Myron. Oh, Myron's coming up? Really? I mean, we know what he's going to say. Is it like even news to watch Myron? I don't think it's news anymore. All right, so I think we could do a summary here on some of this Oracle stuff, but let's go look if there's a little more Oracle news. So the Motley Fool apparently is bullish on them. So the Motley Fool says there are 523 billion reasons to buy Oracle stock. Okay. So let's look at what's dragging down the stock. Let's see. They added 68 billion in remaining performance obligations. They must build out the networks, ideally suited for high performance compute. Bloody, 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 bloody. Buying Oracle stock for the right reasons. It's a high conviction buy. Okay. So if you believe Motley Fool, everything's fine. While the fears are warranted, the bigger question investors should be asking is whether Oracle is making the right long-term move. Right. Well, that's the thing. If you can't prove that we need all these data centers, then all this optimism is worthless. And I think that's what people are worried about. It's like, all right, like how many versions of LLMs do we really need? So the sell-off is a buying opportunity for risk-tolerant investors who agree with Oracle's strategy and don't mind enduring some potentially long speed bumps along the way. That's Motley Fool. And then JP Morgan, and I hate JP Morgan. I used to like them because I thought they would actually provide value to their customers, but they don't. I realized, like, they will shill you trash IPOs to try to make more fees, or trash products that I just hate. Anyway, Oracle, and then they don't even give you their research. Anyway, Oracle aggressive artificial intelligence spending has put cloud compute giant corporate bonds under a harsh spotlight. Yes, this is true. The bonds are the poopy doopies. The JP Morgan thinks that the pressures will persist into the new year. Okay, which that makes it harder to keep borrowing. So it's sort of like the self-fulfilling problem. Okay. So like valuation-wise, it's cheap. It's just you have to believe, do we want all these data centers? Oracle's chief said they will probably borrow less than the 100 billion that analysts are projecting. But if they borrow less than the 100 bill, then how are they going to get all that plant, property, and equipment? Right? Crappy dappy. Google testing sale. Dude, that would be amazing. I would be so happy if Google listed real estate. Oh, that would be so good. That would also help our AI. It'd be great. Google listing real estate. Is that true? Oh, let's freaking go. What is this? Zillow stock fall. I hate Zillow. Zillow stock falls as Google tests new real estate format. Let's go. Google is testing a real estate advertising format that could compete with Zillow. The search giant has introduced a mobile-centric real estate ad format that provides comprehensive property details, options to request home tours, and similar listings. That's fantastic. Oh, that's great. The potential longer-term risk here. Big fan. Big fan, dude. Mega freaking bullish. Honestly, that's even more bullish for House Hack, too, because this is freaking great. Oh, man. If Google can consolidate all of the damn MLS listings, bro, is a collaboration with real estate analytics and brokerage firm Come Home, which sources listings from the MLS rather than from listing agents. The format directly competes with Zillow. This is bullish. Absolutely bullish. Oh, that's great. That's great. Sonny says, why do you hate Zillow? Well, honestly, Zillow built a business off of misleading people. And that forever has haunted me. You know, when you go look at a listing on Zillow, people have always believed that the like agents that show up on the listing are actually the listing agents for the property. And like, I remember I tried it once. They're like, oh, try some free ad credits or whatever. I tried it. People would call me thinking I was the listing agent. And I'm like, no, I'm not the listing agent. Like, I'm just running ads on Zillow. They're like, oh, I want to talk to the listing agent. And people hang up. And I'm like, oh, wait, Zillow's misleading people the way they set up their advertisement, tricking people to call these random agents who bought ad spots, making people think that they're listing agents and they're not. So the whole business is built on a sham, in my opinion. Can we replace realtors with AIs? That is not a bet I would make. And I don't care because it's not a business that I do at the moment. But I can just tell you, I don't think real estate agents are going anywhere for generations. Generations. Like, if I could make a bet on the death of the realtor, I would short that all day long. Just when you're in the industry, you know. If you're not in the industry, you don't know. Anybody who's not in the real estate industry is like, real estate agents overpaid and don't do anything. Anybody in the industry just laughs. Like, you don't even try to respond to that. You just laugh.
Portfolio management fees have contributed about a quarter of a point, 25 basis points, to inflation in the last year. It's big, right? That's a really substantial contribution, way in excess of its historical averages. But it's totally imputed, and it's based on the stock market moving higher, just because that's how BEA calculates it. But if you look at fees in the industry, everybody in the financial industry knows that fees have been in a downward trend. They've been in deflation for 20 plus years. They fell 6% last year in 2024, right? So we know that asset management fees are in trend deflation and have been for decades. And yet, because of the quirks of the measurement process, it ends up being one of the biggest contributors to core inflation the way we measure it. And to me, that just seems really wrong. We shouldn't keep rates too high. We shouldn't ask people to lose their jobs because of quirks of the statistical measurement process. That's just not how we should be setting policy.
So do you disagree with Fed Chair Powell, who said that a lot of the inflation remaining stubbornly high has been tariff-induced?
Yeah, I don't see it that way. I don't see tariffs as being a major driver of inflation. And I went through this in a lot of detail in my speech this morning about why I don't see that being the case. And I've been consistent about that being the case. Now, you might think that if I don't think that tariffs are driving inflation higher, then core goods will stay high for a long period of time, and that would be a problem if I wanted to cut rates. But I see so much disinflation in the pipeline because of shelter that doesn't bother me at all. As I said, market rents have been growing at a 1% rate for a couple of years now. I see shelter inflation coming down below where it had been growing pre-pandemic. And I think Goldman actually just a couple of days.
They did over on Friday.
Yeah.
They see below pre-pandemic, below 2019 shelter inflation.
Ivy Zelman just said it.
Yeah, and then PCE housing going to 2.1 by December.
So they see the same thing. Okay. So look, I don't see tariffs driving core goods at all. But if that's not the case, then core goods may stay high for a longer period of time. Doesn't bother me because there's going to be so much disinflation in the pipeline from shelter that we
see shelter inflation coming down. Let's go.
Disinflation is coming because we can see where the market rents are. They are a window into the future.
To your point, though, on leases, makes total sense. People get how leases renew and they stair step over a year. It takes a while. Couldn't you say the same thing about tariffs or pricing in general? That's contract based. That maybe some of those aren't fully set yet. A seller hasn't had the chance to reset a price.
Yeah, you could.
By the way. And volumes are down in real estate. I think since our closing, we're either at almost or we're just now crossing with some of the numbers that came in this morning, $1 million raised in just the last few days since we announced the closing of the fundraise. So this is like Wednesday or Thursday or whatever, it may have been Thursday, that we announced the fundraise is closing for House Hack, at the August of 2024 valuation, which I think is a steal, but, no guarantees. There's risk with every investment. Read the offering circular. And I think we're at almost $1 million just since announcing that fundraise close, which is insane. But anyway, appreciate the support.
It's
at househack.com.
In a balance. Prices didn't move higher because demand moved higher, and so as a result, it's not necessarily to pull in demand to compensate for that. That's just not how central banks should behave. So I don't yet see tariff-driven inflation. We may get some eventually. We haven't yet. If we do, standard practice would be to look through it.
And you don't really see it in the longer-term inflation expectations. You'd see it show up there, and we're not really seeing that. But here's my question, Governor Myron. Even if you're right and inflation isn't as pressing of an issue as some on the Fed think it is, arguing for a double rate cut at a time where the economy is doing pretty well and GDP is tracking 3 point.
It's not doing pretty well, Sarah. Damn it. Stop shilling for Trump.
One, we don't know exactly how the economy is doing. The labor market has been showing a trend of weakening over the past several years, and
That's right,
there's no
Myron.
evidence that the trend has changed. And the unemployment rate, sort of has poked up a little bit. Now, Congress didn't tell us to target economic growth. They told us explicitly to target employment. And so that's what I think we need to be looking at it. And indicators there are still that we're not at a maximum employment, right? We're actually quite a ways away from it, and the trend that we're on is
But there's
one
not
that we
like
need to
severe
address.
stress in the labor market yet. Yes, the unemployment rate has ticked up.
Yeah.
Yeah,
Trend
but once
is,
it's hit,
is
you're
not
done.
good, but that's why the Fed's cutting rates.
No, there's far from severe stress. The labor market as a whole, as it currently stands, is still currently in a good place. The question is, what's the trajectory and
Yes.
how long are the lags of monetary policy?
Let's
now,
go!
nobody knows exactly how long the lags are, but I think conventional wisdom is they're about 12 to 18 months. I would say that's probably fair. And if that's the case, then you need to make policy now for 2027. We need to make policy now for 2027. And if we are looking at, as I said before, the supply-demand imbalance in housing being more reflective of 2022, right? We shouldn't be making policy for 2022.
lag.
We need to make policy for 2027. And if the labor market continues on the trajectory it's on, and inflation continues upon the trajectory that I outlined this morning, we will be in a really bad spot in 2027 because inflation will be undershooting. Will be down towards our target, and the labor market will be, will be quite a bit weaker because we kept policy too tight. Policy right now is too tight. If we don't take steps to adjust it, it'll be too weak beyond, further out in time.
The statement by Powell the other day that we're overstating jobs by as much as 60K.
Yeah,
is that a widely held view? Is shared by you?
It may be. I'm sort of not one to try and game the revisions in the system. Economic data are almost always revised. CPI, of course, is an exception. I'm not one to try and second guess exactly what the revisions will be. When I try and get a more nuanced view of economic data measurement, it's of the type that I did this morning, not in terms of second guessing as are the data going to get revised away, but more of do the data mean what we think they mean, right? Do the concepts relate exactly to the concepts that we actually want to focus on? And the things that I analyzed this morning, I think the answer is no on a couple of them, right? Especially the portfolio management fees, which, as I said, we all know in the financial industry they've been in trend decline for decades. I don't think that would be surprising to anybody watching this program. Every year there's a new article about how investors are benefiting from the lowest fees ever. So how is it the case this would be one of the biggest contributors to the
I
inflation?
agree. When PCE comes out, we talk about it on every
do.
print. How kind of silly it is.
It's silly. It's a reflection of the stock market.
We shouldn't ask people to lose their jobs for that. I mean, I just think that's wrong. But so I'm more of a let's sort of think about the data in a very nuanced way. Do they mean what we think they mean? Do they relate to the concepts that we actually care about and that the Congress told us to focus on? I'm less of somebody who's inclined to sort of say that the data are sort of false at face value and are going to be revised away. And that may be the case. It's just never really been one of my sort of go-to.
So the other case we hear from the hawks, not just the worries about inflation and we're not at target. The other case that we hear is that doesn't seem like
Is that black nail polish?
restrictive right now. It sounds like you very much disagree with some of your colleagues about just how restrictive
Where's her broom?
now.
Yeah, I mean, I disagree. I think, first of all, if you look at the labor market data, they speak for themselves in terms of confidence indicators of how plentiful jobs are, or small business sentiment indicators about how difficult it is to find employees. I think the trajectory of the labor market data is pretty clear. And then I think if you look at the housing market, which of course is the most important financial condition and most cyclical sector of the economy, it's remained in pressure for a while now. I think that there's no question about it.
But the Fed is cutting rates, and the market rates are not reflecting lower rates, at least on the long end, and that is keeping mortgage rates very high. What do you make of that?
Well, some of that was front run, right? The decline in interest rates happened gradually over the course of the year, even before we actually started cutting rates, and I would expect that they eventually would come in with lower interest rates. I don't see anything in inflation expectations data that make me think that we're making a mistake by cutting at all.
So you don't think cutting short-term rates would steepen further the curve?
No, it might it will steepen further the curve. That's what happens when you cut interest rates. But I would still expect long rates to decline.
along with short.
Yeah. But maybe they just don't decline by as much. I mean, every cutting cycle steepens the yield curve. It's just that long rates don't go down by quite as much.
Yeah, I mean, a lot of people think that that more cuts won't have that big of an impact because, I don't know, there's still some sort of housing shortage, which is keeping prices high. And then there's AI, which may be keeping the unemployment rate drifting a little bit higher. At least we're seeing fewer hirings.
Yeah, well, if we are seeing fewer hirings because of AI, then there's two questions. First of all, I'm not totally convinced that's the case, but if that were the case, then there's two questions. One is that permanent or is that transitional, right? And if it's permanent, then you might think that that's the type of thing that monetary policy shouldn't respond to because it just means that maximum employment has changed, right? The amount of maximum employment has gone down if it's permanent. Now, I would say that I think that we've, the country's, 250 years old. We live through a lot of technological innovations, a lot of technological changes. AI is obviously, if it lives up to promise, it'll be one of the more important ones that we've experienced. But in none of the previous ones did we really have, a permanent change in maximum employment, right? Sectors rise and fall, and new technologies create new opportunities and new jobs. And so I would be disinclined to think that if people are losing their jobs because of AI, I would be disinclined to think that it's in any sense permanent. Now, it could be transitional as new industries get created. And one example that I like to give is that, you think about social media, sort of destroyed lots of jobs in, for example, journalism, right?
Yeah.
But it also created new job categories like social media advertising strategists that didn't exist before. And then we created tens of thousands of
Househack.com.
I don't know what new jobs AI is going to create that we haven't even conceptualized now because we can't even define the category. Like prompter, right? Like, are we going to have professional like I'm a professional prompter, right? Like is that going to be a job that we didn't even think could have possibly existed a year ago?
You don't need professional prompters. The prompts do themselves now.
New jobs. And to that extent, if people are not being employed now because of it, that is something that the Federal Reserve has to accommodate by creating a labor market in which those new jobs can actually come into being instead of snuffing them out before they get started.
Speaking of new jobs, Kevin Hassett versus Kevin Warsh. Do you have an opinion? Either?
I do not make personnel decisions. I think Kevin is a fantastic name.
Somebody says, "Can we buy Househack using the Robinhood Gold Card?" Yeah, technically you could. If you had the Robinhood Gold Card, you'd get 3%, and it's no fees. It's a 20K minimum, but I mean no fees. That's a nice little ROI there. On 3%, you get the Gold Card.
Mr. Trump, and he's just going to do what he wants. This is something that came up when you were nominated to be Fed governor. So I do wonder if you could just reflect on that and whether that's a legit concern.
Yeah, so look, I think the most important thing is getting the policy right. And if you get the policy right, then the economy will do well. And if you don't get the policy right, the economy will not do well. And if you get the policy right and the economy does well, financial markets will reflect that too. At the end of the day, financial markets care about outcomes. They care about cash flow streams.
Can you buy with 10K on each card? Yeah, we'll have to I think the system won't let you, but we could figure that out. Just email us at ir@househack.com.
Email ir@househack.com.
That matters. At the end of the day, financial markets care about cash flow. They care about streams of income. And if the streams of income are good because the Fed is doing its job.
Oh, did I miss? Kevin is a fantastic name. I'll have to go back.
Preventing large inflations, then the streams of income will be good. And financial markets will reflect that, and the economy will reflect that.
So the markets will be the check, which is what I've said about the bond market. But the fact that President Trump really is vocal about wanting lower interest rates, does that not enter your mind? Is that not going to be a force for the next Fed chair?
Look, like everyone else, he's entitled to an opinion. He's entitled to an opinion on rates. We have lots of people in the political world who give their opinions on rates on both sides of the aisle. Lots of people have an opinion, and everyone's entitled to give it. My perspective is that groupthink is really, really bad, and that it's very easy to settle into a lazy and complacent consensus where you don't have your views checked and challenged. And so I want to hear as many views as I can about differing views on the economy, inflation, labor markets, interest rates, so that I can always interrogate my views and figure out where I might be wrong and thereby arrive at a better conclusion.
What are you going to do today, honey? I'm going to interrogate my views.
Else in the world, if it's a good idea and a good thought, I want to hear it.
Who says this? Could you imagine going to beer with this guy? Yeah, I'm going to interrogate my views on this.
Continuing in that role, because that'll be a seat to fill, or whether he would use that to put in the next Fed chair?
He has not talked to me about that. Yes, my term ends the end of January. Yeah.
So you'll be there for the January 28th meeting.
I will be there for the January 28th meeting.
My birthday.
And until somebody else is confirmed for my seat, I anticipate I would continue in that seat until somebody is confirmed for that.
And will you keep dissenting for 50 basis points?
It depends what we do on policy. We have, as you pointed out before, we have been cutting rates, and so the amount of restriction has been declining somewhat. It's still not declined as much as I really would like it to, but it has declined somewhat. And as that amount of restriction declines, the imperative to dissent for an extra big cut becomes similarly lessened. So no, I won't commit to always dissenting in favor of 50.
You're also going to get some new hawkish voters on the committee next year as well. I wonder if you think that's going to change the trajectory of policy.
Yeah, we'll get some new hawkish voters. We'll lose some old hawkish voters, and we'll have to see where
you'll have
where
to battle each one of them.
But look, I'm of the view that monetary policy needs to be forward-looking because of lags, right?
Yeah.
So we need to make policy based on a forecast. A lot of my colleagues have a view that monetary policy should be more data dependent, that you should respond to the data that come out. My view is that's too backward looking, and if you wait to sort of see all the outcomes you want in the data, you're going to end up with a bad policy because of these lags, and so you'll wind up just jumping around too much. Now, if the data come out in ways that are more indicative that lower policy is appropriate, I suspect even the most hawkish of hawks will have a sensible response to that and become less hawkish.
All right. Well, thank you for joining us to discuss the.
Yeah. No, I totally agree. I actually thought this was very interesting because he's talking about trajectories here. So if labor market continues on this trajectory along with inflation, we will be in a really bad spot in 2027 because we kept policy too tight. I actually think he's right on. I'm going to save that because apparently he said Kevin's a nice name in there, and I'm not saving the video for. Sarah Eisen, I promise. Okay, so now let's go see what we got here. Oh shit! That New Year's Eve bombing plot would have targeted Southern California locations. Wow. So that was the FBI foiled plot that I tweeted about this morning. FBI just announced they foiled a New Year's Eve terrorist attack in America for pro-Palestinian extremists. Okay, now hearing terrorist attack would have targeted Southern California, FBI reveals. Yikes. Okay. That's very interesting. All right. Time to start walking around with a gun again, huh? Jeez. Okay, so... It's funny, the other day, I don't know why the conversation came up. It was before all these crazy shootings and stuff. I think Lauren's like, oh, Kevin, you're going to have to walk around with the shotgun. And then I'm like, oh? And she's like, good thing you have a concealed carry license. And I'm like, Lauren, I'm not going to concealed carry an AR-15 framed rifle. It ain't going to happen. But anyway. All right, so what's going on with the stonks? So we've got let's see here. Nvidia is still pulling up, still kind of basically where we were at the open. We are a little below the open on AMDs, still low on Oracle's trying to recover. Q's bobbing around. All right, let's talk about Oracle here. Do a little summary on Oracle. And I did get an update, by the way. We are at, which is incredible, we announced the closing on Thursday night. So on Thursday night, we announced our closing for the fundraise for House Hack. And Wednesday, which I think Wednesday was a smaller day, but we have the numbers from Wednesday. So from Wednesday to today, we've raised $940,000 in basically less than 2 business days. That's pretty remarkable, especially since the banks just basically opened like an hour or so ago out here, at least. But anyway, that's crazy. So anyway, learn more over at househack.com or reinvest.com. But yeah, that closes at the end of the year. So what, 15 days left? All right, let's do a little sum on Oracle here. And let's see what we got cooking. So, all right, let's grab this. And then grab this. All right, a lot to cover here. Okay. All right. Well, folks, Oracle bonds are falling off a cliff. And this is a really big red flag because it means the money printing Jerome Powell is doing might just be pushing against a string. Now we'll look at the fundamentals and we'll see what's actually going on, because that's what we like to do on the channel here, is talk about what's actually happening by looking at the financials. But this morning, I took out this cable. And the reason I took out this cable in the course member live stream this morning is to provide an analogy. I said on Friday, mind you, I said that I expect chip selling and hardware selling to continue. And this morning, markets were green, and I'm like, guys, we do this before the market opens up, right? I'm like, guys, don't trust the pre-market going green. This hardware selling could keep going rapidly. And it's exactly what we've seen. CoreWeave, NBIS, all of them falling off a cliff. But remember, the Fed printing money is in part designed to prop up money for private credit. So if private credit gets propped up, it funds banks who can then fund the bonds for companies like Oracle. The problem is, what you're about to see, we have big problems, okay? So understand for a moment, when the Fed prints money, their goal is to take this Oracle side of the cable over here, call my hand over here, the Oracle side of the cable, and they're like, guys, pump, they're pushing money in, and they're trying to be really aggressive over here. But as you can see, that Oracle side isn't moving that much. And then you get dummies sometimes in the comments who are like, but Kevin, like somebody literally wrote this comment the other day, like, Kevin, all of private credit could literally implode this weekend and it wouldn't be a black swan. And I'm like, you don't even know what you don't even know. Like, you're so dumb. You don't even realize how stupid that comment is. Private credit is a $3.5 trillion industry, okay? Our GDP is $25 trillion. So if I take 3.5 and I divide that into 25 nominally, private credit makes up 14% of the economy. Now add leverage. Yeah, okay. It's a really, really big problem. So private credit issues are an issue. And the issue that we see with Oracle is, as a downstream recipient of private credit funding, Oracle bonds are falling off a cliff. Now, unfortunately, when bond premiums, this was shared on X, shout out to Special Situations. I was chatting with him on X this weekend, and you know, he's making the argument, he posted these, and he's like, Kevin, the problem is when the 5-year bond and the 10-year bond for Oracle start falling off a cliff, this right here is the 10-year bond for Oracle. When they start falling off a cliff, what it means is the market is demanding a higher premium for these bonds. Okay, that's a fancy way of basically saying people don't want this debt. They need to be compensated more for the risk. And that's bad because unfortunately it means they're going to have less capacity to pick up money from Wall Street. Those are selling at a 5% discount on the 10-year. You want to see the 30-year? This is the 30-year for Oracle. The 30-year for Oracle, which is right here, 2055 expiration, it is selling at an 11.5% discount because people do not want to bag hold these assets. And this means even though the Fed is trying to bail them out, it may not actually be enough to make it happen, which is scary. Now, I put this together, which is Oracle CDSs. Now, this is something else that's scary, okay? If you go back to 2008, all the way to the left side, 2008, which I don't have charted, but you'll see that these CDSs peak out at about 128. Well, right now, the CDSs, you ready for this? We ended up crossing the 128 line over here last week. And then all of a sudden, we just shot up even more. We're at 148 right now on Oracle 5-year credit default swaps. They're mooning. This hedging that's going on against Oracle is mooning right now. And so on Friday's Alpha Report, I said, expect the chip sell-off to continue. Monday morning, I said, don't trust the pre-market green, hardware sell-off to continue. And then, of course, we're seeing premiums fall for these. The problem with premiums collapsing for these bonds and the bonds selling at a discount is that you basically, and this is what Special Situations and I were talking about, is Basically, Oracle is going to have to pay more in interest to compensate people for the extra risk. Unfortunately, that means they have to take on more expensive debt to justify their existence. The problem is, Oracle is legitimately telling you that they're so broke that you should bring your own chips. I mean, think about this. If you go to some rich guy's house for a Christmas party, is that rich, really wealthy person going to tell you to bring your own beer? No. BYOB is when you've got normal, hardworking Americans who just can't afford the luxury of paying for alcohol for everyone. And that's normal, okay? But the rich guy inviting you over doesn't ask you to bring your own beer, okay? When you start getting a little tight, that's when you ask people to bring their own beer, okay? And it's fine, it's reasonable. Like, don't be a freeloader, bring your own beer, right? But when a rich company like Oracle starts saying it, it might be a problem. Because that's literally what they're saying, okay? If you go to the earnings call on Oracle, and this is crazy, my mind was blown when I saw a rich company like Oracle saying this. In terms of funding our growth, there are a variety of sources available to us through our debt structure in public bond, bank, and private debt markets. Do you see what I'm saying here? And I haven't even gotten to the zinger yet here, but listen to what they're saying. We have money available through private bond market, which is collapsing. We just saw the charts. It's collapsing. Bank and private debt markets? Oh, you mean the ones that the blind people are going, private debt market doesn't matter. No, it literally does. It literally matters because even Oracle is referencing it. And then, in addition to the public bond market, which is tanking, credit default swaps, which are indicating massive risk, and the private debt market, which is panicking right now, and the Fed is trying to bail it out. In addition to all of that happening, they say, oh, by the way, we also have other financing options through customers that may bring their own chips to be installed in our data centers. Wow, what a party host. Oracle is literally now saying, bring your own chips, so that way we don't have to buy them. They actually get asked about this again later in the earnings call. I wish I was making this up, but you can't. You have an analyst that says, hey, congratulations, blah, blah, blah. Hey, question, Clay or Doug. Oracle is clearly the destination of choice for sophisticated AI customers. Got to prop them up before you ask the hard question, right? That's always, if you ever have to ask a hard question, learn about framing, right? Oh, Donald Trump, you're so great. You're the best ever. Hey, just wondering, how come things aren't going so great with Putin? By the way, love what you're doing on Truth Social. It's all about framing, right? It's a manipulation, right? So anyway, but this is far more capital intensive, unlike any business Oracle has ever been in before. How do you guys raise the funds for this AI growth ahead? Mind you, at the same time, you've got this plummeting going on in the bond market. So basically in English, hey guys, this is expensive. Okay, you ready for this? All right, here we go. One of them is that customers can actually bring their own chips. In these models, Oracle obviously doesn't have to incur any capital expenditures upfront for that model. AKA, don't worry, bring your own chips. So then they try to sell that as, we're chip agnostic. And my translation is, nah bro, we just can't finance this anymore and the bond market is pissed. So now, what I wrote over here, well, let's get into their fundamentals. What else did I write here? Oh, I do have this quote that I've had in my alpha reports since September, October. I've had in my alpha reports at the bottom that CoreWeave, NBIS, Oracle, and IREN have the writing on the wall that these will be bag holding companies. This is a direct quote from my alpha reports that have been, published for like 3 or 4 months. So, I'm not trying to shill anything. I'm just simply trying to say, like, if you go back to the day charts on these companies are round tripping literally since I wrote these notes in September and October. That's when you got your double top on NBIS. That's when you peaked out, or nearly, you had your second essential peak out over here on CoreWeave after their IPO. And that's when you've double peaked out on IREN. All of them now selling off substantially. 9% in the day on IREN, 6% on CoreWeave, 7% on NBIS. And so this writing is clearly on the wall that these are the bag holding companies. Oracle's down another 2.8%, Broadcom's down another 4.5%. The writing's been on the wall. But take a look at the finances, because maybe you don't believe that the bond market is telling you a warning, right? The bond market is screaming, this is a problem. Kevin has been screaming in the Alpha reports this is a problem. I've also been screaming that the Federal Reserve is trying to bail them out, but they're pushing against the string, and it's not working, right? So that's why I think this analogy is useful. Like, they're trying, but they just started Friday. They just started running the money printer on Friday. So it might be early. Like, maybe the bailout will start working. But understand this. Go to the financials for Oracle, okay? The financials for Oracle show that their plant, property, and equipment sit at $67 billion. 67. So, of course, their earnings per share are going up because they're buying actual data center equipment. Fine. But the question is, where do they get that money from? Right now, they have $136 billion of debt. $136 billion of debt works out to 7 years of operating cash flow that these people, like, if they stopped spending today, it would take them 7 years to pay off their debt. That's an eternity. That's a whole chip life cycle. It's probably more than that. But anyway, if you actually go to their net operating activities, you could find that they are, in a 6-month period, they're burning $10 billion in free cash flow, which means they have to borrow money. And that's exactly what they're doing on their cash flow statement. You can see they've borrowed $18 billion. They paid a little bit, $2.8 billion in dividends, so about 15% of that. Then they issued stock, about 5% of that. And they paid off a little bit of debt, about 10-ish, 12-ish% of that. But they've net borrowed massive amounts of money. They have net borrowed and issued $19.3 billion, less the 2.8 in dividends, less the 2.1 in debt payoff. They have net issued $14.4 billion, which is 140% of their negative free cash flow. They are literally borrowing. So they're borrowing every freaking penny to finance their capital the expansion of their data centers. Now, I looked and I go, but hey, like, Wall Street is forecasting that they're going to have net income of $60 billion a year in 2030. Okay, that's cute, because if they had $60 billion a year of net income in 2030 and they stopped borrowing, they could pay off their debt in like 2 years. In less than 2.5 years, they could pay off all of their debt. But the problem is, to get to $60 billion of net income, we looked it up together. We finally found what Wall Street is forecasting for their plant, property, and equipment growth. Right here, this is the line. Wall Street is forecasting that the $67 billion that they have in data centers right now is actually going to rise to 86 next year, 136 in 27, 191 in 28, 241 in 29, 272 by 2030. So in order to actually get $60 billion a year of net income, they're going to have to borrow another $205 billion. That's why the bond market is freaking out. That's why the bond market is falling off a cliff. Because the bond market is like, bro, you guys have $67 billion of data center exposure right now. How in the world are you going to get another $205 billion when right now you're having to borrow at 140% of your free cash flow? You're having to borrow more than your negative free cash flow just to sustain this business. At the same time, you're trying to sell to people, hey guys, yeah, bring your own chips, boys. Well, if people start bringing their own chips, guess what happens? Your EPS forecasts go down even more. That's the problem. Now, yes, on a valuation basis, they don't seem that expensive right now. But that's because the valuations assume the growth that Wall Street is forecasting. So if you use a price to earnings growth multiple, this company's trading for like a 0.8 on a PEG ratio, which is very cheap. But you have to understand the PEG ratio has the G in the denominator. In English, if the growth goes down, the whole formula gets ruined and they look really, really expensive. And the bond market is telling you poop's not doing really well. So it's no surprise this hardware sell-off is continuing. Now, if you actually look at their fundamental earnings, you can also see that PP is compressing at least somewhat, okay? So cloud margins gross cloud margins used to be 77%, but they've actually compressed to 71.2%. So they actually have shrinking PP.
Little PP.
And nobody wants shrinking PP. So at the same time you have shrinking PP, at the same time, you're telling people to bring their own chips. At the same time, the bond market is selling off risk on this company. You have a company that's saying, oh, we can rely on the private credit markets on the bond market. People are going, really? I don't think so. And henceforth, we see the chip market dunking. CoreWeave, IREN, NBIS, Oracle, Broadcom. Now, that's obviously taking, the market down with it to some extent. I mean, we were green like 70 basis points this morning on the Qs. Again, this isn't to shill the alpha membership. It's just to say we were green this morning on the Qs. And I'm like, that's great. But like, watch the first 5 minutes, because I wouldn't be surprised if we see the chip sell-off continue as people rotate out of hardware. The pre-market doesn't matter. What matters is what institutions are doing. And institutions don't see these issues lightening up. Look at the JP Morgan call. So if you go, and I know JP Morgan's not my favorite, you'll know that, but you can still see what their credit analysts are saying, and they obviously throw money around. Look at this. Oracle is a show me story after big debt bet, JP Morgan says. JP Morgan expects the company's bond pressure will persist into the next year, which isn't great. On top of that, you've got, the only people who are really bullish on them are Motley Fool. And I know there are a lot of people who aren't really enthused about the Motley Fool, but the Motley Fool is like, hey, there might be some big speed bumps ahead, but as long as you can weather this, maybe, and you believe they're making the right long-term move, maybe you can pull this off as a high conviction buy. That's cute, but that's also where we just have to ask ourselves, how many data centers do we need for the same frickin' models? Okay, well, if we keep getting improvements in artificial intelligence, maybe this is all just a hiccup in the road. Maybe the funding will come through. This is the bull case, right? The bull case is the Federal Reserve is able to print money. It supports the private credit woes. The private credit woes go away. Private credit ends up with a lot of liquidity and cash. The liquidity crisis ends because the Federal Reserve is printing money again. Private credit then goes and funds the Oracle data center expansion. And we need more data centers because AI keeps getting more and more powerful. Great. That's the bull case scenario. I mean, I know there are bull case scenarios for artificial intelligence. We don't actually need a lot of data center capacity for our productivity and net worth boosting AI that we do at my startup. That's househack.com, reinvest.co, same company. We just raised, we announced that we're closing the fundraise at the end of the year, and we raised $940,000 in effectively the 2 business days after we announced that close, which is awesome. People are plowing money in, which is great, and we're going to put it to great use. So there are winners in AI, and I think we're part of that. I mean, I'm grateful to say, knock on wood, that we're EPS profitable with this giant boost that we got from artificial intelligence of people buying our product or a service. But anyway, there will be winners in AI, and there will also be losers. But the problem is, a lot of this data center explosion is leading a lot of people to get really optimistic about things that could be these really crazy long shots. Frankly, not only Oracle, but also, if you haven't seen it yet, I encourage you to watch my SpaceX video. So I made a SpaceX video about the next 10x in data centers or whatever. And if you jump in over here, the next 10x in stocks, Elon Musk, you can watch that video. Wow. And I talk about the SpaceX IPO, but we talk about specifically data centers in space, how people are talking about this. We talk about the SpaceX valuation. We talk about the Terminator zone, basically 24/7 cooling, which is great in space. But power, 24/7 power in space. But people think that space cooling of chips will be useful, but you actually introduce new problems. You don't have airflow in space. And you need ammonia-based cooling, which is very damaging for humans. So you need robots to be able to really service the equipment, which maybe is good for Optimus robots if we can make it there. But the question is, all this hype around data centers in space, is it being hyped up to help Elon Musk sell SpaceX stock? Or do we actually need the data centers? See, one of the big downsides of SpaceX that people complain about is, hey, yes, Starlink is great, but do we actually need to send a lot of cheap payloads to space? And there's competition for these payloads as well. China's working on their reusable rocket, obviously copying Elon. Jeff Bezos and Blue Origin just successfully landed their reusable rocket, obviously copying Elon. GPS technology has gotten really good, right? This is have you ever done a drone, return to home? it's kind of the same GPS technology, just on a much larger scale. But anyway, it's not to downplay what they're doing, but the point is, like, the biggest objection to SpaceX investments have been, well, what are we actually going to send to space when we can make all these trips to space? What about data centers? Great sales pitch. Everybody be like, oh, that's a great idea. As long as the data center boom doesn't go bust. And right now, we're at a really precarious turning point where we're not sure if the Federal Reserve's money printing is going to be enough to support private credit, to support the bond market, to support Oracle, and support this continued data center expansion. So, Oracle should really be an oracle of bad things to come if this Fed money printing doesn't work in bailout. So this is scary. That is a very big problem. So anyway, it's also possible that banks are just hedging against data centers. Right? Maybe that's why the CASs are going up. But you need to raise debt to get their earnings to actually continuously prove that this company's expansion plans are going to survive. Now, again, valuation-wise, they actually seem dirt cheap. But if for whatever reason our data center needs collapse, all of these investments go poopy-doopy. And that is the big fear, is that Oracle investments go poopy-doopy. That means IREN, CoreWeave, NBIS go poopy-doopy. If they go poopy-doopy, then NVIDIA and AMD go poopy-doopy. Google TPU, nobody cares about anymore. And all these custom chips go poopies. And then we don't need data centers in space, at least for the foreseeable future. That's the big risk factor. And I think that's what markets are really worried about right now. And then people look and go, oh, I guess it was, in hindsight, it was all a bubble after all, right? So anyway, that's the situation. Somebody says data center under the ocean, free cooling. Yeah, hey, you know, there are a lot of different ideas for where to put the data centers. The wild thing is there's also plenty of land on Earth. And we have planned out a whole lot of data centers already. And the question is it a sustainable level of spend? And what most experts seem to point out when it comes to studying history, so history experts, is that you really can't have a new revolution, like a new industrial revolution, without a bubble. So it's not a matter of like, will there be a bubble? Anytime there is a change in an industrial revolution, whether it's cars or radios or data centers, there will always be overinvestment because capitalism is in part fueled by optimism and hope. And that leads to overinvestment, overcapitalization. And every single technological revolution ends in a bubble. The big question that people have right now is, well, are we in a bubble now or are we going into the bubble? JP Morgan, Goldman Sachs, and Morgan Stanley, all of them argue that we are actually not in a bubble yet, that we are going into the bubble. Unfortunately, the one thing that's creating cause for concern is the skyrocketing of credit default swaps at Oracle, the plummeting of premiums on Oracle bonds, and you can't forget the 10-2 spread. The 10-2 spread is another issue. Remember, this was the chart of the 10-year and the 30-year bond for Oracle. But then, you know, you factor into this as well what you have with the 10-2 yield curve over here now at 67 as well. Exactly the same numbers, how much Oracle has in plant, property, and equipment, 67 billion. It's just 67 is just everywhere right now. But the question is this a signal of greater shock sensitivity coming? So we'll see. Maybe we're just in the expansion phase. My hope is that the Federal Reserve's money printing bails us out. But that's where we stand. Okay, cool. So that gives us a breakdown over here. Let's take a listen to what's over here for a moment.
So to speak, in quotes, certainly into the midterms, but you get some, policy air behind you. You have monetary policy behind you. The idea that the Fed is cutting into what appears to be, in many respects, a strengthening economic case, not necessarily a weakening one. That's the premise that I meant. And maybe I wasn't clear enough about it, but that's what I'm talking about.
Yeah, the economy is really only expanding if you keep AI up. Absent AI, probably in a recession, which is kind of scary. Okay, great. So, let's see here. Yeah, the SpaceX IPO, we talked about it 5 days ago. You can check that out over here. My venture capital company has a lot of exposure to. We made 2 venture capital investments. SpaceX was one of them, and Apptronic was another. And both of them have like, I feel like 3 or 4x, something like that. Depends on what the dilution will end up being and when these go public and stuff. But both of them have like 3 or 4x, and we're like, oh damn, this is great. I actually originally I was worried. I'm like, I feel a little concentrated only picking 2, but now I'm kind of grateful I picked 2. But anyway, so yes. So what else here? Let's see. So we talked about the Zillow thing. Let's go see what else is on the Doomers quickly. Let's actually go to the Doomer station too, because I do want to sum up what the Fed is up to as well. But we might do that in a bit. I'd like to find like an old meeting from Warsh, because I'm not the biggest fan of Warsh. I'm really nervous that Warsh is going to. Part of me hopes that in the short term, I don't want anybody to get hurt, but part of me hopes that in the short term the market sells off to send Trump a signal that Warsh is a bad pick. Because if the market sells off, Trump will think it's because of his Warsh pick, which, I tweeted, which I totally think, is what he'll think. And then he'll U-turn on Warsh, which is exactly what I want. Like, I do not want Warsh at all. I think he's a big mistake. Again, maybe it's worth making a whole separate video on it. But, yeah, it's a little poopy doopy, I'll put it that way. But we'll see. Okay, yeah, and if you haven't seen the reinvest video I did yesterday, I did a reinvest video yesterday, walked around some properties. I showed some before and afters as well. If you haven't seen the before and afters, they're pretty good. I have to say, I always think it's funny. I always get these comments every single time I make a real estate video. I get comments like, but Kevin, corporations shouldn't be buying real estate. Like, okay, well, if investors like me don't buy the real estate and fix it up, then how's anybody going to live there? And see, the reality is the vast majority of properties are owned by mom and pops. Entities own a very, very small sliver of real estate, especially single-family real estate. But if you go to... I'll just show, I've got a couple before and afters here that I don't think I showed. Get a picture here. But yeah, we joke about it on the inside. Oh, here it is. We were joking about this, for example, in the in our company chat earlier. Where is it? I get that screenshot. I sent this message. I go, but you're taking homes from people. And then you look at the home on the left. It's like, really? You want to live in that mold disaster? This is disgusting. And then this is what we provide on the right. And then guess what? Families go move into it. It's great. So we think we do great work, but I mean, there's always going to be somebody who has a misimpression or it's got some hate or whatever. I don't know. Let's listen over here.
This category.
Absolutely. Thank you, Eric. Joining us to talk about this ETF, I'm pleased to say, is Jeffrey Rosenberg. He is Senior Portfolio Manager of Systematic Fixed Income over at BlackRock, and, of course, one of the managers on this new ETF. Great to see you in person.
Great to see you. Great to be here.
So let's talk about this new launch, because I'm taking a look at the name. I'm taking a look at your website. You say that IALT combines the potential for alternative investing with the convenience of an ETF. What about this is that alternatives exposure?
Yeah, so a number of things. So first of all, there's a lot of confusion around alternatives. The discussion you were talking earlier with my colleagues about private credit and different alternative asset classes. That is not what we're talking about here. We're talking about alternative strategies. And what Eric talked about, hedge fund like strategies is really what we're anchoring on. And what does that mean? It means long, short, market neutral investing, right? So when you think about what we have available to us in the ETF world, and again, Eric's segment, how small this category is, because investors in this wrapper haven't had access to these types of strategies. And what's differentiating about these strategies is they get to what's underneath the surface. Right, so much of what we talk about in markets, we've talked about over years in markets, are rates going up, are rates going down, stocks going up, do you like AI, do you not like AI? But there are so many other things happening in financial markets underneath the surface, and that's what we try to get at in this fund through a long portfolio, through a short portfolio, and taking out the market directionality with the idea, basically, that this can lend another source of returns through investing in all the stuff that's underneath, both on the long side and the short side.
You gotta love them. These people are so good at selling all their different funds. Okay, so let's see here. Elon Musk and XAI unveil Lynx chatbot to complement Grok. A new AI platform will be more focused on blockchain analysis and digital asset intelligence. All right, so what else here? What else? When's my next vacation? Friday. Yeah. Oops. But I already announced that, so I don't know, like, is the market, like, pre-selling that, you know? So, I don't know, we'll see. So somebody says, Kevin, is it still possible to invest in Househack as a non-accredited investor? It is. In fact, the round that's open right now is the non-accredited round. So if you go to househack.com or reinvest.co, it's the same company. This is our AI product, which you can buy lifetime access to. You can see all about that right here. The price will go up when the product actually comes out a lot. It's already gone up quite a bit. But if you click the invest button, you get a 5% yield plus all the upside. We pay that out on a monthly basis, so it's annualized, paid out monthly. It's real estate backed. Obviously, the company's real estate backed. We've got a bunch of debt-free real estate, no bank debt. You can invest with a credit card, ACH, or wire, and there are no fees to invest. 5% yield paid monthly through conversion. Conversion to stock only takes place if our valuation exceeds the valuation today. Read all the details in our offering circular. Obviously, there's risk with every investment, right? But like we're pitching it as this idea of like, hey, you get exposure to tenants and toilets without the headaches of tenants and toilets, and so you get to diversify away from the markets at these crazy prices. You get to diversify into real estate in like sizzle hot locations, in my opinion, and wedge deals that I handle, plus our real estate SaaS. I think it's kind of cool. It's kind of cool. So yeah, no MKV. I think there's a data center bubble. I think that's different. I think artificial intelligence has huge opportunities, especially in healthcare, in finance, in real estate. There are going to be huge productivity boosts for artificial intelligence there. But you can't really conflate these two things, right? Like, I'm not running a data center play. Like, I think a data center play, that'd be bad, because I think that's where there's a bubble. But actual real estate or artificial intelligence productivity, that we're just at the nascent stages. We're at the early stages of that, right? It says 20K minimum. Yep, it's 20K min. Yeah, our average investment, I think, is about 26,000, though we have seen that really flip-flop lately to a lot higher. Like, we keep getting six-figure investments. And they're really popping off. In fact, I have this chart that Gemini made. I gave Gemini just the dates and the amounts of investments, not people's names and stuff. But anyway, we have this chart of investments, and this is old now because on the right side, this chart's going to have skyrocketed already. So this on the right is going to be a lot higher. Like, we're going to surpass this over here. But Gemini thinks there's retail erosion versus whale dominance, where we used to get smaller checks under 50K at the beginning of the year and almost exclusively in the summer. Actually, I didn't even pitch much over here in the summer. But this is because we were secretly ramping our AI product. And then we announced our AI product over here. And as we announced the AI product, we saw a big inflow of investments. And then this chart's going to be the highest as we're now closing the round. But there's a higher percentage of yellow, which Gemini calls the whale investor of over $50,000. Higher percentage of bigger ticket investments. And people say this is like maybe wealthier people going, oh, yeah, we see this potential. I don't know. That was Gemini's take. I thought that was very interesting. Okay, good. So what else is going on in the stickies? So CoreWeave, Corey's trying to recover. NBIS, look at that bounce. Oh, within 36 cents of my line over there. IREN's not really bouncing at all. Yeah, I've had like quite a few venture capital companies reach out, or like financial companies that work with venture capital people. They're like, Kevin, we need a pitch deck and we need projections. And I'm like, I don't have that. And they're like, well, make it. And I'm like, well, I'm going to close the fundraise first. And then I'll make you guys a pitch deck. I don't like, pitch decks and stuff, but I'll have to figure out how to do a Kevin version of it, I guess. Anyway. All right. So, Apple's right on its line. And then we've got, NVIDIA and AMD are trying to hold on to their early day. Broadcom's still selling down, although Oracle's finally recovering a bit. Our minimum never changed, this whole fundraise. No. So it like, if you're wondering if the minimum changed during this cycle, it did not. During this fundraise, the minimum's always been 20K. Nothing's changed here. So, yeah. Okay. What else do we have here? Okay, let me go to info. Okay, so what do we have here? This is XAI has been an uphill battle selling Grok to businesses. Elon Musk suddenly talking about space data centers. When will we reach AGI? Who cares? Okay, let me see here. That's that. All right. XAI. Elon Musk wants the companies around the world to buy Grok AI models as it tries to build a money-making business. To get there, XAI has created an enterprise AI sales group over the past year and a half. Oh, really? Expanded to more than a dozen people. Wow, Elon hired salespeople? That's crazy. But XAI's lack of experience in selling to big businesses is holding many potential customers back. While XAI has signed up some big clients, including Morgan Stanley and Palantir, they're generally conducting small tests, each bringing in hundreds of thousands or thousands of single-digit millions in revenue, that's on the low side. And Morgan Stanley was also an advisor, so that's kind of circular. Palantir, they probably just integrate it, right? XAI has raised a total of $27 billion in debt and equity. SpaceX has invested into XAI, right? Because they need money. XAI needs money. It's probably another reason why I think Elon wants to rush the SpaceX IPO, because you're going to get so much money that then you could throw back into XAI to beat Sam Altman. Somebody says, I took the refund of my Fisker Ocean deposit and bought HouseHag with it. Oh, that's awesome. I wrote this Daily Wealth yesterday. I encourage you to sign up for this if you don't get these yesterday, but I'm gonna make a little note of this. I just want to highlight it. I wrote this Daily Wealth yesterday about coming clean about debt, and I thought it was really good. You can get that Daily Wealth for free if you download the Meet Kevin app, and then you go to the Daily Wealth tab. But part of it is like, as an example, we will go buy like an expensive car or a boat or a plane or whatever, and we think that's going to be a big game changer, and then when you're saddled with the payment, payments are like so deadly because they screw up your focus on what really matters. We should be investing and building for the very long term, but instead when we get focused on, I need to make this stupid payment for my house or my car or whatever, you kind of lose your focus a bit. And so I think I realized that only after paying off all of my personal debt, and HouseHack doesn't have any bank debt, and it just lets us so hardcore focus on what matters most. And I'm just very, very excited about this. Ross has access to our AI. This is what the AI picked, and it's a good one. Good job. I know the place. We should buy it. Let's go. The AI. Ross is one of our, is in on it because we've got a board meeting tomorrow. And he's like, oh, damn, this is actually good. I'm like, that's what I've been saying, Ross. That's awesome. There's a lot. I just want to share this story and this roadmap with all of you. Wedge deal guy turned YouTuber who's now trying to scale doing wedge deals with all of you. And it's just a really fun journey. So, yeah, let's go. Let's go. Okay, good. So what do we have over here?
One thing that might not be as well understood is just how demand in the secondary market, regardless of who it's from, but any kind of sizable demand for mortgage-backed securities ultimately is seen as very positive for the sector.
Boring.
And will award 3 winners scholarships totaling $250,000. The national finals will be held in June 2026 in Washington, D.C. That's a lot on the line. Back to you.
All right, Bertha, thank you. Bertha Coombs. Up next, more portfolio moves from the investment committee. Steve Weiss has just sold a name.
Don't care.
Wait for it to come to you. It might happen for some people, but that is no guarantee in life.
Absolutely. I think what he said was a great message to anyone working anywhere. And, back to the AI piece, AI is a tool. So it doesn't just show up at your doorstep and start throwing money at you. You have to use that tool to generate something for you. So you should take control of your career. And I think people, even if you are entry level working at McDonald's, there's a lot of upside for you, but you should be looking at it and don't wait for someone else to show up and help you. I love it.
Okay, so I was having a debate over the weekend with somebody who was talking about schools that don't give grades below a certain threshold, Brian. And I said, why? Because if the person earned a bad grade, then somehow it's this idea of like you're going to make them feel bad if they get an F in something. If they got an F, they got an F. They should know that they need to work harder. But some schools have that kind of policy. So, when you're looking at the clip of the CEO talk.
What are my thoughts on Section 179, 100% bonus depreciation on a 6,000 pound vehicle? Look, I get it. But the reality is, I think you really have to ask yourself, do you need the vehicle, right? Like if you're a contractor and you're like, bro, I could really use a Sprinter van for, my electrician business or whatever. And you're going to put some racks in the back that are going to make you a more functional person. Big fan. Like, fine. If your business is growing, great. Do it. But, I really do worry that a lot of people look at tax loopholes as a way to justify bad expenses, and it ends up being a mistake. So, I'm just trying to talk from experience too. I've seen the temptations of tax benefits. I think it's so funny. Like, everybody's like, like cost segregate all the real estate. The funny thing about like the real estate that we buy, for example, hold on, there we go. We don't really even need to cost seg because we have so much depreciation on straight line. We could use that depreciation year over year. If you fully write it off year one, that's great. You get your benefit up front, but then you don't get the recurring benefit. So, some downsides there. Yeah.
That saying where
ooh, Taylor Riggs. I like how it says tough love.
Help you open the door, but then
ooh, hi Taylor with the picnic tabletop.
Take advantage of that. That's sort of what I take from this, where I can't just sit back and expect this big door to open for me. Maybe someone along the way will help me, and that's nice to open up that fresh opportunity. But once you get that opportunity, it has to be yours to take.
May the Lord open.
You have to be the one that works, that shows up, that still, I think, relies on mentorship and connections. And so maybe it's sort of a mixture between everything.
Saying all the right words here, Taylor.
Agreed. Brian, to your point on your kids, sorry, just quickly, I think they have to be in control of putting themselves in a position to partner with people. So control, I didn't mean it as like it's all me, I'm in control, I run everything. It's controlling your career. Your career might be you're a great number 2 or number 5 or just a piece of the cog. You're not the head man or woman running the business, which is fine because not everyone can be the head. But it's kind of like knowing your place, knowing your position.
And putting yourself out there to be noticed in that way. That's why I was saying I don't think that things are actually distinct, what you're talking about per se. But Dakin.
What the McDonald's CEO is saying is bullseye. And he's actually saying it in a nice way. Certainly it depends on the industry in which you work, the type of business in which you work. But broadly speaking, you can only worry about yourself and your job performance, your job, and what you are doing on any given day, week, month, or year. If you worry about what other people are doing, your colleagues, what praise they're receiving, what accolades they're receiving, what promotions they're receiving, you've taken your eye off the ball, because you have no idea why someone else is getting something that you want. The only way that you get it is by focusing on you, your abilities, how much you work, how well you work. You will never get the desired raise, promotion, job that you want unless you focus on yourself and your own work and work ethic, what you can do better. Because I'm saying it, this business, the one that we work in, is not literally deadly, but it is.
What is she on about?
And if you're worried about what other people have and what other people are getting, and it will drive you absolutely insane. You can only focus on what can I do to do a better job. You also can't be afraid to quit. You also can't be afraid to fail.
I don't know what the hell she's on about. I'm gonna change the channel. I'm tired of this. Maybe I can get back to Sarah Eisen or something over here. I don't know anything but this. Nope. Got an ad. Yeah, a little too much meth. I think she needs a little bit of Hims medication. Oh, I don't know. Maybe I just went in midstream there, but something went a little oopsie doopsie there. Not exactly sure. Oh well. You know, I think that everybody's just bored. Oh, all right. Well, I think that probably does it. So I will. I'll see y'all in the next one, and good luck out there, and good luck to